Want to know why so many investors lose money, even when they invest in good companies? Benjamin Graham had a simple answer. The biggest enemy of the investor isn't the market, it's what's happening inside your own mind. Today, you'll discover 5 common investing mistakes Graham warned investors about, why emotions can destroy your returns, and the principles you can use to become a much smarter investor. Mistake number 1: confusing investing with speculating. The first major mistake is assuming that buying a stock automatically means you're investing. For Graham, investing meant conducting careful analysis, seeking reasonable protection of capital, and expecting an adequate return. Speculation is different. Speculation is mainly betting that the price will go up. Imagine buying a stock because everyone online is talking about it. The price rises 20%, and suddenly you feel like a genius. Then it falls 30%. What changed? Maybe the business didn't change very much. What changed was your perception of the price. Graham reminds us of something fundamental. The price you see on the screen is not the same thing as the true value of a business. Mistake number 2: letting Mr. Market control your emotions. Graham created one of the most famous metaphors in investing, Mr. Market. Imagine you own a business with a partner who comes to you every day and offers a different price for your share of the business. One day, he's incredibly optimistic and offers you a huge price. The next day, he's depressed and offers you much less. Would you sell your business simply because your partner is having a bad day? Probably not. But that's exactly what many investors do with stocks. When the market falls, they become afraid and sell. When the market rises rapidly, they become excited and buy. The problem is that they end up doing exactly the opposite of what they should. They buy when optimism is at its highest and sell when fear is at its highest. Graham's lesson is powerful. You don't have to follow the market's emotions. You can take advantage of them. Mistake number 3: constantly trying to predict the market. Another common mistake is believing that you need to know what the stock market will do tomorrow, next week, or next year. Will it rise? Will it crash? Will there be a recession? Will interest rates fall? Will a new bull market begin? The problem is that nobody can consistently answer these questions. Graham didn't build his investment philosophy around predicting the future. He built it around buying with a margin of safety. In other words, you don't need to predict the future perfectly. You need to prepare for being wrong. And that distinction can completely change the way you invest. Mistake number 4: buying because everyone else is buying. This mistake is especially dangerous in the age of social media. You see a stock going up. Everyone is talking about it. Someone posts that they made thousands of dollars. And suddenly a question enters your mind. What if I'm missing out? That feeling is commonly known as FOMO. But Graham teaches us that the market doesn't necessarily reward whatever happens to be popular. Intelligent investing requires independent thinking. Because when you buy simply because everyone else is buying, you're allowing other people to make your financial decisions. Remember, the fact that everyone wants to buy something doesn't mean it's being offered at a good price. An excellent company can become a terrible investment if you pay too much for it. Mistake number 5: investing without a margin of safety. This is probably one of Graham's most important concepts. A margin of safety means avoiding a price that requires everything to go perfectly. Because your estimates can be wrong. Earnings can fall. The economy can enter a recession. A company can make mistakes. And you can be wrong. A margin of safety works like a financial cushion. If you estimate that an investment is worth around $100, you may not want to pay $100 and assume your calculation is perfect. The idea is to buy at a sufficiently lower price so you have some protection if your expectations turn out to be wrong. You don't need to eliminate risk. You need to prevent a reasonable mistake from destroying your wealth. And here's the bigger lesson. Intelligent investing isn't about being smarter than everyone else. It's about controlling what you actually can control. You can control how much you pay. You can control how much risk you take. You can control your expectations. You can control your emotions. And you can decide when not to invest. Because, as Graham taught, one of the investor's greatest advantages is the ability to wait. You don't have to buy today. You don't have to sell today. You don't have to participate in every opportunity. Sometimes, the smartest financial decision is simply saying, "Not at this price." Now I want to ask you, which of these mistakes do you think is the most dangerous? Following the market, letting emotions take over, or paying too much for an investment? Let me know in the comments. And if you want to learn more about investing, financial psychology, and the principles used by great investors for decades, subscribe to the channel. Remember, the market doesn't have to be your enemy. If you control your emotions and protect your capital, it can become your ally.